President Donald Trump just called for a 1-year 10% cap on credit card interest rates. This is a nationwide credit card APR cap starting on January 20th, 2026. He announced it publicly without a detailed enforcement plan, and Wall Street analysts plus legal analysts are openly skeptical it can happen without Congress. So today, we're going to do a clean historical breakdown. No cheering, no booing, just facts. What Trump says he wants to do, what presidents actually did in the past when they wanted to squeeze borrowing costs, and finally, what this kind of credit policy uncertainty can mean for access to debt capital, especially for small businesses and government contractors. So stay to the end, because the business credit line part is the plot twist that most people miss, and small businesses and government contractors need to understand the most. So let's get into it. Welcome to the next episode in our series titled America's New State Capitalism, where we take a look at economic policies that seem kind of out of frame for the general American public. And here's a simple version on what President Trump is stating that he wants to do. He says that he wants credit card companies to charge no more than 10% interest for 1 year. Reporting describes it as a proposal announced on social media with big questions about how it could be enforced, because a president doesn't typically have unilateral authority to set private credit card interest rates nationally. And the reason this hits markets immediately is obvious. Credit cards are a major profit engine for banks and issuers, and even uncertainty about pricing can move stocks. Plus, when you talk about the ability for small businesses to be able to manage their debt capital, this can be a huge change. Now, before we time travel, let's go on one quick map and get something understood, because this whole topic will get confusing fast if we don't. So the best way to understand the differences between what we are looking at in credit and the ability for the federal government or president to limit the amount of interest charged is to look at this as a 2-lane highway. On one lane, you have private credit. On the other lane, you have federal loans. So let's talk about lane 1, private credit. Think about credit cards, payday loans, personal loans. That world is mostly shaped by state law, Congress, and regulators, not a president acting alone. Lane 2 are federal loans. This is especially about federal student loans, where the government can change terms because it's the one administering its own lending program. So think about it like this. In lane 1, the president is not the DJ. In lane 2, the president can at least request the playlist. And that's why the cleanest modern example of a president limiting interest is not about credit cards, but rather Trump himself in his last term when he made student loan interest 0%. And then Biden obviously extended that. So to bring it back there, during COVID, federal student loans got emergency relief. In the March 2020 phase of that relief, the government paused payments and temporarily set interest rates to 0% for covered federal student loans. Then in August 2020, President Trump issued a presidential memorandum continuing student loan payment relief, again tied to the 0% interest approach for covered loans. And on January 20th, 2021, the Biden administration announced that at Biden's request, the acting Secretary of Education would extend the pause and keep the interest rate set at 0. Now, that's a big difference from a credit card cap. This was the federal government changing terms inside a federal program. So what happens when presidents try to influence borrowing costs in the private credit lane? Historically, it usually wasn't a clean APR shall be X. It was something older, wonkier, and very powerful in emergencies. So what is this older, wonkier, and very powerful in emergencies mechanism that the federal government is able to use? Well, to understand this, we have to understand the historical playbook. Think credit controls, not simple APR caps. And let's go back to the history, because in the 1940s, 50s, and 1980, presidents confronted wartime inflation and economic overheating with a tool called credit controls. Think not every lender must charge 10%. Rather, it's more like we're tightening the terms, down payments, repayment period, eligibility, so borrowing doesn't flood the economy. And this first started in 1941 when FDR signed Executive Order 8843 with Regulation W. What is that? Well, in 1941, Franklin Delano Roosevelt signed Executive Order 8843. It was published in the Federal Register, and it was to support consumer credit controls during wartime mobilization. The executive order empowered the Federal Reserve to implement a regulation called Regulation W, which set nationwide rules for installment credit terms, like minimum down payments and maximum repayment periods. It's important to remember that during this historical context, installment credit was the major way, and usually the main way, that Americans were able to access debt capital. And here's a key detail about this that people often mix up. Regulation W was not a law passed by Congress. Rather, it was a binding Federal Reserve regulation issued by the Fed's board under authority referenced in the executive order. Now, Roosevelt didn't write the fine print. He pointed the Fed at the problem. Truman, on the other hand, during the Korean War, issued credit controls and real estate restraints with Regulation X. During the Korean War, credit restraint returned, this time extending into real estate credit rules known as Regulation X. And we can see how temporary these emergency-style tools were. The Fed suspended Regulation X effective September 16th, 1952. It was tied to the Defense Production Act amendments and relaxation of controls. Meanwhile, a compiled Defense Production Act reference notes that the control of consumer credit terminated on June 30th, 1952, and control of real estate credit terminated at the close of June 30th, 1953. Again, this wasn't APR equals 10%. It was emergency credit plumbing. Tighten, relax, suspend, terminate. And then we get to President Carter, 1980, Executive Order 12201 and the Credit Control Act. So let's fast forward from the age of Truman all the way up to Carter. This is the 1980s. Inflation is the monster under everyone's bed. Jimmy Carter signs Executive Order 12201. Authorizing the Fed to use powers under the Credit Control Act to regulate and control consumer credit. And that authority didn't live forever, by the way. The U.S. Code notes that the Credit Control Act authority expired at the close of June 30th, 1982. So here's the big historical pattern that's coming up, and it matters for understanding today's credit card cap headlines. And while we know today's headline, the question is going to be, what do we think the next headline is going to be about this 10% cap, and what's going to influence it? Well, what's going to influence it are historical efforts and how they ended. When presidents used credit controls historically, the cleanest documented endings weren't usually a dramatic court finale. No, rather they were sunset and shut-offs. Think Regulation X was suspended in 1952. DPA credit control titles terminated in 1952 and 1953. The Credit Control Act authority expired in 1982. These policies often got taken out by the three most powerful forces in Washington. Congress, calendars, probably the most important. We're not doing this anymore. Now, let's get back to Trump's proposed 10% credit card cap. And why didn't markets flinch if analysts think that it's unlikely to become law? Well, why markets and lenders care, even if it's just a proposal, is because credit cards are huge business, and the average credit card interest rate is already around 20%. So a 10% cap would be a major pricing shock if it ever became enforceable. That's why we saw immediate reactions in issuers and even companies tied to credit partnerships, like airlines. And multiple outlets have emphasized the same core uncertainty. A nationwide cap would likely require Congress because the White House and regulators can't simply set private credit card pricing by announcements, or so say many analysts. Now, this is the promised plot twist that you've been waiting for. What could this kind of credit policy uncertainty mean for access to debt capital, especially for businesses? And while businesses are important and are going to be the main focus of what we're talking about, it's important to note that debt capital access can affect consumers, businesses, government contractors. The list can go on, because whenever big policy ideas target credit pricing, whether they become law or not, lenders and markets tend to do two things. First off, reprice risk. Second, tighten underwriting. And if you think, oh, okay, remember that this could have a direct impact on the total debt that you're allowed to take out on your credit card because the interest rate, the profit margins or safety margins, have gone down. However, this just doesn't impact credit cards. It can ripple into broader lending behavior because uncertainty makes lenders want more confidence and more cushion. Now let's talk about government contractors and their businesses for a moment, because this audience lives in the real world of the invoice is approved and the payment is, well, it's on its way spiritually. Gov contractors often rely on working capital lines of credit, revolvers, and invoice-based financing to bridge payment cycles. In a tight credit mood, lenders typically lean harder on fundamentals like clean financial statements, diversified customer mix, strong contract backlog, and predictable receivables. In uncertain times, lenders fund boring and documentable first, and government payment timing, now certainly with shutdowns, is many things but rarely boring. Now, this is not financial advice, just historical patterns. When credit condition feels politically or economically uncertain, capital will get pickier. So what's the clean historical lens you can use the next time a headline says president caps interest rates? Well, here's the filter. Which lane are we in? If it's private credit cards, a nationwide APR cap is usually a congressional plus regulator story. And right now, Trump's 10% cap is being reported as a proposal with unclear enforcement and major legislative hurdles. If it's a federal student loan, well, presidents have clearly used executive action to keep interests at 0% because the government controls the program. And historically, when presidents are pushed on private credit, it often looked like credit controls, terms and availability, implemented by the Fed under emergency frameworks and later suspended, terminated, or allowed to expire. So if this helped you understand both what President Trump put out, the historical context, and how this may affect your business and yourself, please make sure to subscribe, hit that like button. If you have any thoughts or any comments or any questions, go down below. We try to answer every single comment and respond to every single question as they come in. As always, thanks for watching. We'll see you next time.